Hey everyone, and welcome back to the Tesla Stock Podcast. The votes are counted, the dust is settled, and the mandate is official. Tesla is pivoting. The shareholders have spoken, and they want Elon Musk to turn this car company into an AI and robotics juggernaut. But now that the easy part, casting the votes, is done, the incredibly hard part begins. We are looking at a roadmap to an $8.5 trillion valuation. But getting there might require what leadership is calling the hardest year in the company's history. And interestingly, some of the biggest bulls on Wall Street are starting to take chips off the table. With Tesla stock currently trading around the $406 mark, seeing a bit of a pullback recently, we need to dig deep into the math behind the trillions, the internal pressure cooker at headquarters, and the moves of the smart money. Let's get into it. Let's start with the big picture. We've heard the headlines about Elon Musk's pay package potentially being worth $1 trillion. But what exactly does Tesla have to achieve to unlock that for him? What does an $8.5 trillion Tesla actually look like? A fascinating analysis came out this week from Barron's that breaks down the math, and it is staggering. To unrestrict those shares for Musk, Tesla doesn't just need to sell more cars. It needs to hit specific, massive financial targets. The biggest one is reaching $400 billion in annual EBITDA. That's earnings before interest, taxes, depreciation, and amortization. To put that $400 billion number in perspective, Tesla is expected to generate about $13 billion in EBITDA this year. That means the company needs to expand its earnings roughly 30-fold over the next 10 years. That sounds almost unfathomable. If you look at it through the lens of a traditional car company, it's impossible. Ford and GM aren't doing that. But here is the bull case argument. If Tesla pulls this off, if they hit that $400 billion profit number, the valuation suddenly makes sense. Right now, Tesla trades at a very high multiple, over 100 times its earnings. But if they hit these targets, the stock would trade at around 18 times EBITDA, which is exactly in line with the Magnificent Seven tech giants like Apple, Microsoft, and Google. Essentially, the shareholders have placed a bet that Tesla can transition from a high-flying, speculative stock into a mature, cash-printing machine, just like those other tech titans. But is a 30-fold expansion even possible? Well, there is one precedent that everyone is looking at: NVIDIA. Before the AI boom, NVIDIA was generating maybe $5 to $10 billion in EBITDA. Now, Wall Street expects them to hit nearly $190 billion by 2027. That is the kind of explosive, exponential growth that happens when you hit a technological vein of gold. The thesis for Tesla is that they will use NVIDIA's chips to create the physical AI applications, the robotaxis and the Optimus robots, that will do for Tesla's income statement what the chips did for NVIDIA's. Personally, I think this highlights the binary nature of the stock right now. If the AI bet works, the math actually holds up. If it doesn't, and Tesla remains primarily a car manufacturer, hitting $400 billion in earnings is mathematically impossible. So, we have the financial target, but how do you actually build the products to get there? That brings us to our second story, which gives us a rare glimpse behind the curtain at Tesla's internal culture right now. According to a report from Business Insider, Tesla's Vice President of AI software, Ashok Eluswamy, recently held an all-hands meeting for the company's most critical teams, the Autopilot and Optimus engineers. This wasn't a victory lap for the shareholder vote. It was a rallying cry. He reportedly told the staff that 2026 will be the hardest year of their lives. He warned them to expect to work more intensely than ever before. Why? Because the timelines they are chasing are incredibly aggressive. Elon Musk has stated that he wants the robotaxi service operating in 8 to 10 cities by the end of next year, and he wants volume production of the Optimus robot to start by the end of 2026. This confirms that the hardcore culture at Tesla isn't going anywhere. We're talking about teams that are already known for working long hours. Elon Musk himself mentioned that his weekly update meetings with the Optimus team sometimes run until midnight on Fridays. This is the execution risk that comes with that $8.5 trillion valuation. The company is trying to solve two of the hardest engineering problems in history, full autonomy and humanoid robotics, simultaneously, and on a deadline. Telling your top engineers that the next year will be the hardest of their lives is a double-edged sword. It shows immense focus and drive, which investors love, but it also raises the risk of burnout and turnover among the very talent needed to build these products. I think this is a reality check for anyone who thinks the stock price will just drift up magically. The trillion-dollar payday is the incentive, but this hardest year is the actual price that has to be paid in blood, sweat, and tears by the engineers. Finally, let's talk about how the market is reacting to all of this. Despite the long-term optimism, we are seeing some very interesting moves from some of the biggest Tesla bulls. Cathie Wood's ARK Invest, arguably the most famous Tesla bull on the planet, has been selling Tesla stock. For 4 consecutive trading sessions recently, ARK offloaded a combined total of over $30 million worth of shares. And they're not the only ones. Regulatory filings show that Kimball Musk, Elon's brother and a Tesla director, also gifted nearly 15,000 shares recently, which is often effectively a sale. Now, before panic sets in, context is key. Tesla is still the #1 holding in Cathie Wood's flagship fund, making up nearly 11% of the portfolio. ARK has a price target of $2,600 for 2029. They're not abandoning ship. This is likely just prudent portfolio management, trimming a position that has run up 72% in 6 months to rebalance risk. However, it does coincide with some technical weakness in the stock. TSLA shares have slid recently, dropping about 5.7% in November so far and retreating below key technical levels, like the 50-day moving average. The market seems to be in a show-me phase. The euphoria of the shareholder vote has worn off. The sugar high is gone. Now investors are waiting for the next concrete catalyst. The biggest one on the horizon is Elon Musk's promise to remove safety monitors from the robotaxi fleet in Austin by the end of this year. Until we see that happen, until we see a car driving empty with no human oversight in a complex environment, the stock might struggle to find its next leg up. Even the biggest believers are taking a little bit of risk off the table while they wait. So, to wrap this up, number 1, the math. We have a clear financial roadmap. To justify the valuation and Musk's pay, Tesla needs a 30-fold expansion in earnings, mimicking NVIDIA's AI trajectory. Number 2, the grind. Internally, the company is gearing up for the hardest year, pushing its AI and robotics teams to the limit to meet aggressive 2026 deadlines. And number 3, the market. Short-term, the stock is facing pressure, with major bulls like ARK Invest trimming positions as the market waits for the next tangible proof of autonomous capability. So, this brings me to my question for you guys this week. I want to hear your thoughts on that internal meeting. Do you view the hardest year rallying cry as a positive sign of a focused, intense culture that will win at all costs? Or does it worry you? Does it signal potential burnout and a chaotic rush that could lead to mistakes? Let me know what you think about the execution risk in the comments below. As always, if you found this breakdown helpful, please smash that like button, subscribe to the Tesla Stock Podcast, and hit the notification bell so you don't miss our next update. Thanks for tuning in, and I'll see you next time.